All right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, coming from the studio just outside Minneapolis, Minnesota. It is an honor to have you here. We don't take it for granted, the fact that people all around the country and really all around the world tune into this podcast for updates related to taxes, finances, topics that you're probably not going to hear many other places. And so we thank you for joining us, and we want to make sure that your time here is valuable. Today, we're going to be jumping into a new series related to the 7 areas that people end up overpaying in taxes. So really the 7 areas that you should be on the lookout for and trying to think about how can you be more advantageous, how can you be more strategic in the way that you approach each one of these areas, because any one of these areas can be a burden to your bottom line. Taxes, again, I've said this over and over, it is the largest expense of your lifetime, but it doesn't need to be. We can tap into certain strategies, we can tap into certain approaches to our financial life that can mitigate our tax liability and lower that so that it's a much smaller percentage of our bottom lines, much smaller percentage of our income, much smaller percentage of our overall expense column. And you have come to the right place to find out just that, where we are focused on helping everyday Americans, business owners, entrepreneurs, real estate investors, high income earners, you name it. We want to help you lower your tax burden. And we do that by creating strategies and creating plans that are legal and ethical and in line with the IRS and what they're telling us, as well as advantageous to you and your net worth, your family's wealth, your bottom line on your business. And so if you've come here for the first time, welcome. You're tuning in at a great time, because we're jumping into this new series and these are going to be life-changing topics that we're covering. And so today we're going to be doing one of 7 most common wealth-killing tax mistakes. Most people are making mistakes on their taxes. And so when you come to us, the first thing I'm going to do is review your tax return to identify if there's any mistakes or missed opportunities. This would be in the missed opportunities, but sometimes it is a mistake in that people just categorize things the wrong way and it results in a higher tax burden for them. So let's jump into it. Not going to take up too much more of your time with an introduction, but we heard stories of people being in the ultra wealthy, the Elon Musks, the Jeff Bezos, the Bill Gates, and having this target on their back about the fact that they don't pay their fair share in taxes. Are you earning it in a tax smart way? We have a client who is a high-level executive, W-2 income of over $500,000. I'll call it disenchanted to discover what his tax rate was compared to others making similar amounts but paying far less, right? So we have high-level executive in one column, and then we have another client who's making the same amount of money, but he's paying little to no taxes, and it's because of the way that he's making the money and the way that he's investing the money. So client B, who makes $500,000 in income just like high-level executive, the first year working with us after we implemented a tax plan, was able to pay $0 in tax and then also got a refund back on top of that, even after making $500,000. It was because we were able to create a structure and a story on his tax return that said that, yeah, he made $500,000, but he had $500,000 plus of deductions and credits and things that lowered his taxable income. His income came from a lower tax environment. He wasn't working harder. He wasn't grinding and gritting his teeth trying to find ways. He wasn't cheating the system. He was just playing the smarter game. He was just using what the IRS has told us and the advisors, if you will, that knew the best approach to his tax situation to then mitigate any taxes that he would have paid had he not hired us. I'm telling you, if you're working your butt off in a W-2 or even self-employed income, you're likely in the higher tax brackets. But a few shifts can mitigate those taxes and bring you down to a much lower tax bracket. I can't guarantee that you're not going to pay any taxes, but I can tell you that if we shift the way that we think about your income and how you're making income, there's a high probability that you will pay less in tax over the rest of your life than you are right now. So let's talk about it. And this isn't just like our clients. You can read stories. I'll tell you, look up when you're done listening to this podcast, look up the story of Warren Buffett being in a lower tax bracket than his secretary. And he was telling us how wrong it was that he was in a lower tax bracket than his secretary. However, he was just playing the game. And if it was really that wrong, then he wouldn't have played the game in the first place. So whether or not you like Warren Buffett, whether or not you agree with his approach and what he says out loud versus what he does, like the point is that he was playing a game and strategizing around the tax code while his secretary was just making income and trying to make ends meet. So it really comes down to how you're making income, right? So you think about Elon Musk, you think about Jeff Bezos, you think about Bill Gates, you think about Warren Buffett. These guys make money based on their businesses and the stock interest they have in those businesses. They get dividends based on their investments in those businesses. Dividend income is treated much differently than W-2 income that you're earning at your job. So that's a starter. When you make income, whether it's at your job, you're a high income earner earning a W-2, or just off your business without any entity structure planning, you are going to be in the higher tax bracket than if you are making income on, say, capital gain income or pass-through business income or dividend income, investment income. All of these are treated differently, and W-2 income is taxed at ordinary rates. Self-employed without any entity structure is taxed at ordinary rates plus some payroll taxes that you're going to be paying. That's going to be the most costly of the interest. Dividend income, capital gain income, all taxed at lower, more favorable rates. We can talk about why it is. I always like to give reasoning to the way that it's set up, because if we can rationalize what's going on, it will help us better understand our current approach and how we can change our approach to make use of what that is. As the government looking at that investor with a lot of capital to deploy, I'm going to want to incentivize that investor to deploy the capital in our economy, right? And so what we do is we frame the tax code to incentivize certain types of investments. So when you think about an investment, you can be investing for the short term or the long term. If it's short-term investments, it doesn't do the economy much good for the long term. When your core goal is to provide for society, not just today, but for over the course of decades, generation after generation. And so if my investor has $100 million and I know that, and I want him to benefit society as a whole by investing that money, but he's a wise investor. He looks at things as opportunities and threats compared to just putting money into something. Like you know that he's going to want to have an incentive for deploying his capital. Otherwise, he's just going to hide it under the couch, if you will, the proverbial couch, and not really do anything. If there's no added benefit for him to, say, invest in a business where he won't see the money for 10 years versus buying something in the short term that provides him with immediate pleasure, well, he's probably going to buy something in the short term. But the tax code and our society, our politicians, have now created an environment that incentivizes long-term investing, because long-term capital gains are taxed at more favorable rates than short-term capital gains. Short-term capital gains will be ordinary income. Long-term capital gains will be long-term capital gains tax rates, which cap out at 20%, maybe 23% if you also pay net investment income tax on top of it. Say I have $100,000 in commissions versus $100,000 in my sale of stock, or $100,000 of my sale of property, with the assumption that both of those, stock and property, were held for more than 12 months. $100,000 commission, no deductions, no entity structure planning. Let's just use the 24% tax bracket, for example. I don't have the tax brackets in front of me, but let's just say you're in the 24% tax bracket at $100,000. That's $24,000. Now, our tax system is not, you make $100,000, it's all in the 24% tax bracket, so you pay $24,000. But for round numbers, without getting into the math of it all, let's just say $24,000. On top of that, you're going to pay 15.3% for payroll taxes, what's known as self-employed tax, Social Security, Medicare tax. You pay this when you get a salary, but because you're self-employed, you don't have to pay it technically because you don't pay yourself a salary. So the government basically says, well, to make up for what you aren't paying, we're going to charge you the 15.3. The employee and the employer portion of the payroll taxes, Social Security, Medicare. So you got the $24,000 at the 24% tax bracket, and then you pay 15.3% on top of that. So that's $15,000. 24 plus 15 is close to $40,000. So you made $100,000. You didn't take any deduction. You're paying close to 40% of your taxes, even at a minimal tax bracket, right? You're not in the highest tax bracket. You can project that out and you're paying even higher when you get to the 37% tax bracket. But you understand the point. That is no small amount. And it's usually these types of people that end up going into debt to the IRS because they didn't do entity structure planning. They're just getting their business started. Maybe it took off a little bit more than they expected. And they come to us in March or April saying, hey, I need you to do my taxes. I don't have any money to pay for taxes. What's my tax bill? And then we have to return it to them. Listen, you didn't do any entity structure. You don't have any deductions, and you made $100,000, $200,000. This is what you're paying in taxes. And it's astronomical. Compare that to the person who has strategically planned and now all of their income is, say, capital gain income, and they get $100,000 of capital gain from the sale of their stock or even the sale of their business or sale of their real estate. $100,000 at a 15% capital gain rate is $15,000. That's $25,000 less than what you would have paid if it was all in the commissions without deductions. You can see, I mean, what would you do with $25,000 extra dollars that you would now have because of the way that your income was classified, right? People are like, well, all I'm doing is making commission income or business income. I don't have enough money to deploy into new investments or properties or what have you. How does this pertain to me? Well, the same thing goes, right? If you're able to make $100,000 or $200,000 and it's all getting taxed at the self-employed tax rate and your ordinary income tax rates, that's going to be a lot higher than if you, say, did some entity structure planning. You can form an entity where it's a C corporation and now all of your payments come out to you as dividends. That's an option. I mean, that takes a little more of a proactive approach, and there's costs and benefits to it. And so what I would recommend all of you to do is to sit down and understand what kind of income you're making, what kind of buckets you have. So there's the ordinary income rate, there's the capital gain tax rate, and then there's the tax-free rate, right? Some of these high net worth people have used the tax code to allow them to open their eyes to the possibility of tax-free income. And you do this by looking to areas where the tax code allows for you to tap into some sort of equity or cash available without paying taxes. It's called leverage. It usually comes in the form of debt or loans against a certain asset, loans against a life insurance policy, for example. This is what's known as a policy loan. The tax code says that debt is not taxable. So what some people will do, whether it's high net worth, like Elon Musk and Jeff Bezos, or just somebody who understands this and they have enough equity to tap into where they can take a loan out against something, then they can tap into their assets, the value of their assets, the equity that they've built up, whether it's in their own property through a home equity line of credit, whether it's through a stock portfolio and taking a loan against the stock portfolio or retirement account, or an insurance policy and taking a policy loan against the cash value. Taking that money out as a loan is tax-free. And so you can do this. You can see how this would benefit you. Say I tap into $100,000 of my stock portfolio, get it as a loan to me personally. Now, that $100,000 taxed at the ordinary income rate would be $24,000 in taxes. But because I tapped into it as a loan, I get it tax-free. The only cost is an interest payment that I'm making on the loan, which sometimes, if it's a life insurance policy, will likely go back to me personally. That's why people say be your own bank. You can pay yourself the interest personally. And so if you find yourself in these high tax buckets, all of your money is being taxed at the ordinary income rates, maybe you're paying self-employment tax on top of it, then I would encourage you to seek advice, to knock on new doors, right? Seek and you will find. Knock and the door will be open to you. That's scripture, and it relates to your relationship with God, but we can use it to apply to other areas of our life. If you are concerned around the way that you're making money, if you're worried that most of your income or all of your income is taxed at these unfavorable ordinary income rates, it is time for you to reach out and seek advice. It's time for you to find the answers that are there and understand how you can approach it differently, right? And so what I would encourage you all to do, call to action, do this, is to see what kind of money am I making? How much money am I making? And in what buckets is it falling? And once you have those answers, the next step is, what are some of the other buckets that I can either open up or transfer to so that not all of my income is at these high tax bracket environments? And once you do that, I would encourage you to seek out a proactive tax planner who is going to walk through these things with you. And this isn't just here and now. This is also planning for the future, right? We want to be wise with our finances, and part of that is planning for the future and planning for the legacy that we're going to leave. If you have the option of ordinary income rates, capital gains tax rates, or tax-free rates, which one are you going to choose? Which bracket are you going to want to fall into? You'd be crazy not to say tax-free. And most people know about the Roth IRA and the option that you have to invest and then to tap into it in retirement completely tax-free. It's great. I would encourage everyone who can to max it out, but some people are phased out because their income's too high and then they think they're out of luck. But there's other options available to you to put yourself in that tax-free bucket. You just need to proactively plan and have an accurate inventory of what you're dealing with. And so for all of you listening, whether you're making $500,000, $5 million, $50,000, wherever you are on this journey, I would encourage you to, at the end of this episode, step 1, take an inventory of your income amounts. So if it's just W-2, it's just ordinary income. If it's just business with no entity planning, it's just ordinary income. If it's entity planned business, whether it's S corporation or C corporation, it's a little different. It's salary, ordinary income plus pass-through, which is ordinary income, but you avoid the payroll taxes, right? You can all do this. I know you can. And so then step 2 would be to consider what your plan is for the future. Maybe you have some money saved for retirement. What kind of buckets are those in? Is it ordinary income? Is it tax-free? Is it tax-deferred? Where are you? And so once you have that, then bring it to your accountant and say, hey, I want to plan around the types of income that I'm making. I want more in my capital gain income than I want in my ordinary income. Or I want to find ways that I can still make ordinary income, but maybe get more deductions or invest strategically where I can offset that ordinary income through the investments. I'm telling you, one of the best ways to mitigate taxes is to strategically plan your investments. Many people know about real estate, but there's other areas that you can invest in that will benefit you, whether you're making a W-2 income or business income or investment income. And so you want to be working with a CPA who can guide you in this game and help you and plan with you and getting a feel for where you're at by taking the inventory of your income and your investments to plan for the future. I trust this was valuable. Tune in next week for number 2, big mistakes that people make. We're doing a 7-part series, the 7 areas, the 7 biggest tax mistakes that you can make and that are costing you and many others tens of thousands of dollars over the course of their lifetime. Until next time, God bless you and keep moving forward.